Good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for April 18th, 2021, Sunday night. So we're looking at day trading frames. Many thanks to KH for providing us the framework. All right, so the first one we have is AMD. Interesting because it's in the chip space, which is in a shortage, so it's on everybody's mind, as it should be. And we have, let's see. So we've got the weekly chart here. The daily and the 65-minute here. The thing that always jumps right out at me is this structure. Combined with this one. Oops. So we're poised to make a breakout, and then the next target would be up here, about 87. So we'd be getting an entry vicinity 83. So we're looking at +4 and about one unit of risk. So we got about 4-1 on this one on the 2 hourly. That's good. So we're already, we would be entering above the hump of the dragon, but it has to get through this little piece here. I think we could be looking at adding a second one, a second position around 84. I think I'd be looking at a second. Yeah, that seems a little high. Maybe not. Maybe not if we're waiting to see a breakout above this. Okay, I'll buy that. This is a nice target levels to the upside in here. So there's a real clear price ladder. And this last little piece, so very strong move to 90, from 60 to 90. And we've had 1, 2, and starting to find its support level here. Yeah, this feels pretty good on the weekly. This could be ready to go. You know, it's had 30 days to fail further below 70 and below 80, and failed to do so. So that's a pretty solid base of support. Yeah, that feels pretty good. Yeah, I like that. But entering around 83. Second position, just a little over 84, aiming for 87. And then if you get 87, you know, you're above this one, and 90 is in sight. Yep. And then if you get 90, then everybody that's in here, 95, 98, and 100, sure. Yep, AMD looks good. And the increase in economic activity is going to demand chips, and that's what AMD does, making the machines that make the chips. So I think they're in a excellent economic position to take advantage of economies that are opening up. Japan next. All right, so we've got the, we still have the weekly. Excuse me. So looking at weekly, daily, 65-minute. Nice triangle happening. Kata 2, anyone? You know, the only worry I have here is that we really have to get above that. But we get through 70. This should be okay. Target 71. Minuscule risk. 1, 2, 3. 3 to 1 to the top side. And then if this breaks, then this is the next target, 71.5, then 72. Yeah, you can't really argue with this, can you? So yeah, any breakout from here, it's just going to keep going. And this is a chance to get that, taking advantage of this is a Kata 2 all day. We probably should have had the entry in here Friday. But I would take it again here. Yeah, at some point the rest of the world's got to catch up to the U.S. gains, and this would be a natural. You know, the real choice is there. Is it going to be Japan, Asia less Japan, or more broadly emerging markets, or China? I think China's got problems. So this seems like a pretty good choice. Conservative, aggressive, and more of a global approach. So yeah, I don't think you're hurting here. The mighty Tesla under increasing pressure from all the other car companies that hate them. So weekly, daily, 65-minute. Leg 1, consolidation. Leg 2, effort at consolidation, which failed. Consolidation, but this is the 50% retracement back to this consolidation, and this feels like it's holding and trying. So this feels really strong in here. The fanboys are holding steady at 625, and 600 turned out to be a really nice springboard once, twice, and then this last time, this one held at 670 and gave a nice bounce. So that gives us that Kata 2, 1, 2, nice double bottom on the 30-minute. Explosive breakout from here, from 700, like a coiled spring. And now we got this little action. So yeah, I think if this holds, then this is in play, and then 800 is in play. So you're looking at plus 50 and maybe $10 or $15 risk. Sure. That's a natural. If you want to be short that thing, yeah, you could be short at 730, target 700. with the follow-on to 680. I would expect that really to hold. So I wouldn't be thinking about more than that on the downside. But yeah, that looks tradable. Mochi the Wonder Dog agrees, if you can hear her. All right, so IWM, that's been the outperformance. A consolidation range that was, 160 to 140, so about a 15% oscillation. This one was from 230 to 210. That's 20 points. That's only about a 10% oscillation. So the size of the consolidation area was actually smaller on this rebound, although it felt very volatile. But notice that the PSAR and Southern Skin of the Dragon worked pretty well. You've got 3 measured levels of support. That one was a little troublesome, but I like the 3 higher highs. And we've had one surge from here already, which held. So all we're asking it to do is hold the bottom of the dragon with a nice tight risk of about $3. So if that can get long here, what's it, like 225? So there's 5, 10. That's 3 to 1. Just to the top up in here. I'd really almost call it 2 to 1. 2 scoops. That looks really promising because you're breaking this double top if this goes, and then this was like a gap in here, so that shouldn't really. I guess the first, 228. You're looking at about $3 here and $3 here, so that's 1 to 1. So it's got to get through here. I think it's worth taking because if it gets through there, that next scoop goes very fast, and then it's really testing this all-time high up in here. So, yeah, I like that. I think America. That looks good. The downside on that one, first position short, that you have to be short by that one, so it's worth like taking maybe half a position here. Then if that finds support, I'd be quick to cash it, but then if it breaks this, then it's going to go to 215 and 2. This would be accompanied by a massive sell-off in SPY, and you would also see VIX really working well, and that's at such a low price right now that if you had a contingency order in at about $11 on the VIX, you could either play this the Russell or the futures on the short side, or you could just play VIX long as part of a general equity market spike. So you have a couple different strategies that are handy on the downside. Because if it's the downside scenario, it doesn't matter which one of the big targets you're using. VIX will really dominate in all of those. And they won't all go down individually. They'll all go down together, and that would trigger the VIX to go. Like if we looked at... that would be nice to have some price action on here. TC 2000, not working. Okay. All right. We'll skip that one. All right, we'll go. We'll just keep driving on. DQ is the next one. Let me let that come up on your screen. Okay, shift to connection. So we'll just drive on with DQ next. I'll try coming back to VIX later, because that's kind of a general principles play anyway. All right, so again, we've got weekly, daily 65. Okay, got it. This thing had leg 1 consolidation, leg 2 consolidation, leg 3 was extraordinary, and this great big sell-off all the way back to 70. Wow. And now found support. So this feels like a complete redo. That whole clean energy meltdown from PBW, which went from 140 to 85 and is still stuck in that reset. A bunch of components in a number of the clean energies have been rebalanced and reset. So this could actually be the start of that next leg with new components. So I actually really like this. Excuse me. I really like this rising lows, strong finish. Plenty of upside opportunity. People will feel that the froth had been blown off. So you got a couple really nice strong targets on the way up to 85, 80, 75. And you're talking about a $3 risk inside here. So that looks really good. The short side trade is obvious. It'll come down to here and then all the way back to 40 if that fails. So the downside is clear and the upside is clear. This is perfectly postured critical state, and this is where it starts. So that's a really good find. When you look at the comparison between DQ and PBW, DQ actually had the juice, and the 1 week it's already making the turnaround that PBW has not yet. And this thing has suffered by far. So there's a lot of folks that owned it from up in here that are looking to get their money back. So I think this thing is postured for a nice measured rebound back to 100. I like that find. I would keep the pair trade on with PBW. Keep that on your radar, though, because with its rebalancing, it might be an easier play for people that are feeling burned by this one. But this one offers some, it looks like the turnaround may already be happening on that one. Next one up is kind of the complete other end of the spectrum, lumber, trees. So my youngest daughter got bit by the trading bug, and she works in the ID card place at Kansas University, and she's got her little paycheck, and she put $150 into her Roth IRA, and we learned how to buy stocks and ETFs this weekend. And the one that we bought was cut. Because of that. And because of these. So the best time to have bought lumber was 20 years ago or today. And a year from now, you'll wish you'd bought it. That's my theory. So we bought hers for the long run and just started buying trees. So we're going to have that as a wide stop, using the southern skin of the dragon as our position sizing stop, and we're just going to follow through on that. I wish she'd have come home on Thursday or Wednesday so we could have bought it here instead of what will be up there, but so be it. This is not one I think you can easily buy intraday. At most, it's on the hourly chart, but it's very thinly traded, anything less than that. And so I really, I think this is probably the most tactical you can get, is the 65-minute. Like, you can't really drill down to the 1 minute chart. If you're just looking at the 65-minute chart, that's probably as granular as you can go. But I do my work on this one off of the daily and the weekly. But that one's, that should continue to do well as long as home builders are building and the Fed is printing and there's no end in sight to either one of those, and people leaving the cities to live in homes to work from home. That all needs wood. Renewable resource. There are more trees and forest acreage in North America today than there was in the 1600s when the Caucasians first showed up. And that comes from forest management. So there's a strong economic argument there for property rights and sustainable capitalism. You want something that eats carbon out of the air? Plant a tree. All right, our last one here is U.S. Steel. This was the other one that was on a short list. With my daughter, we were talking about, lumber versus steel. So we bought one share of U.S. Steel anyway, just to be able to compare. We basically bought one share of the following, just to get her started. We bought one share of Cut, one share of U.S. Steel, one share of Ethereum, and then the balance into the S&P 500. So I wanted her to be able to see the difference between direct commodities, digital currencies as stores of value in times of inflation, and rebuilding and infrastructure. That's these first two. And then the disruptor technology, the second place disruptor technology, and then the idea of the long-term low-cost indexing. So U.S. Steel, nice strong support here, using the principle of the southern skin of the dragon with the stop at 19. Could be buying this with $3 of risk on a weekly swing. On the shorter term, 2267 versus 22, so it's 0.6 or 0.7. So that's almost a 5-to-1 difference, or a 1-to-5 difference in terms of risk box. I actually think this is in a pretty good place to get started for the swing, because you like to see that. So you feel like it could, if you want it on the long side, you really want it to do this. I mean, you really want this thing to take off and break above that high and this high and across the dragon. So that's, your optimism says you want that to occur. And if that were to occur, then this would either here or here would act as a really strong support in order to keep that whole move working. That would be consistent with the chart pattern and the price action, which is basically holding support at the spine of the dragon or the southern skin of the dragon. And so you're getting these support levels. And then to the upside, you're thinking 27. So in a rising, this feels like a channeling. It comes down, it held support, and now it's just getting ready to start. So that makes this perfect timing on getting that. And that was the lesson I was teaching her about, buying on dips and rising markets on things that have long-term strength and reasonable tactical potential for the next leg that allows you to earn some markets money to replace your risk of $3 with the gains of $5 so that you have money in hand that now you can take your risk out of that. So that was the lesson we learned about U.S. steel. This was the lesson about low cost indexing, dollar cost averaging for the long run, fire and forget for 50 years. Hey, if the U.S. is still here in 50 years, the S&P 500 is going to be amazing, whatever's in it, and you'll own it. And you won't have worried about anything in between. But if the U.S. is not here, then any money put into investment accounts doesn't matter because the world will have ended. So it's it's like Pascal's wager. So Ethereum was the choice to teach the lesson about disruptive technology, alternative currencies, to talk a little bit about political and policy risk and what disruptive and what selling Ethereum is selling shovels to cryptocurrency users. So maybe we can see that. Now let me zoom back over to VXX because that's now come up on the screen. So the idea behind VXX with respect to the IWM trade, let me let that come up on your screen. It should be there in a second. So the collapse in the price of VXX is normal. It has that time decay. By any measure, that's what it does. It has long, steady decays, except for those periods of time when, at the end of the last long slide, it gets that wild, violent Z3 breakout excursion, which then leads to this kind of short-term madness. God dang it. Leads to this kind of short-term madness where it went from, 14 to 80. That was COVID. And then this long, steady decay that gets punctuated by these short tactical swing spikes, almost like a heartbeat. How long in between those spikes, you ask? 6 weeks. 6 weeks. 8 weeks. So that's about 8 weeks. 8 weeks. 8 weeks. 6 weeks. This one is right where you would expect. Down around Z2. And the only thing that hasn't happened is that Z3 pinch and stabilization. So this says you have to have at least a stop for the Z3 breakout here. To me, I think I like it around 12 to account for that kind of spike, because that won't get you overly excited on a short spike. But anything bigger than that, to me, just having a contingency order in at 12 gives you the ability to participate. And then I might pick 17 as reasonable. And then probably another one up here at 21. So those are, just good until canceled contingency orders. And so if we saw that kind of breakdown in IWM and all of the other indexes, why then those three should protect you against, runaway explosions. Doesn't cost you anything. All right, so that's everything I wanted to cover tonight. I'm going to record a separate session that talks about the construction of the indicators for the foundations, guys. Maybe I'll just do that. If I put a pause in here now and cut you loose, I'm going to maybe just keep recording this one while we're here and see if I can't make something happen here. No. Now I'm going to record that one separate. I'm going to take a break and hang out with the family a little bit. All right, so that's everything I got now. I will hang the build your indicator screen set with the logic of why I pick the ones that I do. I'll have that hung tonight. Those of you who've been around for a while, that won't surprise you. All right, good evening, guys. Ken at Tortoise Capital. I want to record a short session on why I array my screen the way I do and the indicators I use and what purpose they serve. So I want to start first at the end, like you always do. And this is what we're going to end up building towards. This includes 3 different Bollinger Bands with look back 30 on price that defines the river, the floodplain, and the extreme edges of volatility as the outer red lines. And then I'm going to add the dragon, which is a shorter term Bollinger Band that times the shorter term trends a little bit, gives us some context. Then I'm going to add the 4 regression lines that give us insights into fair value over 4 different time frames. And so I'll add those in, and then I'll finish up with the parabolic stop and reverse, which gives us some guidance on swing trade stops. And that'll be that. That's kind of how it will go. So all I did was made a clone. So this is a snapshot of IWM. I like the bars rather than candles. I use bars because there's less information. If I were to make this price style candles, what I found is that it's almost too much information. It's like blinking lights. And especially if I make it, let's say maybe net change or open versus close, it gives me too much information to interpret when all I actually really care about was the range and the travel time. I put the just one color. I just looking at the travel distance. It gives me enough to see where price was fighting, and I can see the start and the end, and I know if it was up or down based on that. Maybe I wouldn't object to having the color code on there for price, but I just prefer thin, clear data, and less information is more on this for me. I use 3 Bollinger Bands. Bollinger Band 30,1, and that's the inside darkest blue region. That's a 30-period look back, plus or minus 1 standard deviation, and I mark off the simple moving average at the middle in red because that's like the dividing line on traffic. And I use 30 rather than the standard 20 because you need 30 data points in order to be statistically significant for parametric stats, and because it's significantly different than the default of 20. And I use the Bollinger Bands a little differently than a lot of traditional systems that use Bollinger Bands. And so I just like the confirmation of 30. Plus, when I get the least squares moving averages put on here, the moving regression lines, I'm using a fast and a slow of 10 and 30. So I'd like to see the volatility aligned with the same look back period of 10 and 30. So in this case, I'm using 30. Now, the way stats works is that the standard deviation is generally going to array a third of the price between average and plus 1, and then a third of the data from 0 to minus 1. So if I go back 30 periods, 1, 2, 3, 5, 6, 7, 8, 9, 10, 11, 12, 16, 17, 18, 19, 20, 5, 6, 7, 8, 9, 10. So this is the 30 period look back. So we're just going to mark that off. And the range of normal on this for the current bar finds this range of normal between, actually I should tighten that up just a little bit. Yeah, between plus 1 and minus 1. Fully 2/3 of the price action of the last 30 days is contained inside this average plus or minus 1 standard deviation. And that makes these indicators of abnormality way out here. Here's one that went all the way out to Z3. Here's one that went to Z2. What that difference between normal and abnormal does is tell us extreme cases, and then reversals from extremes, as you can see, become very interesting. So here's one where it already had an excursion outside of the river, so that was abnormal. Then it gapped up, but then sold off sharply all the way to Z-2, and then you had a move from 206 all the way up to 236 in about 7 days. That's a 15% move. And then another 15% move that brought it all the way back down here after it reversed outside of the, in fact, it got all the way to Z2. So there's very little data. Only 0.5% of the data is out here beyond Z2. And that goes into the mathematics of computing standard deviations, all that. So the river gives us the range of normal. Now, what I want you to realize is that although these are drawn as lines, they really represent a series of thin slices, so that each day, you drop off one price and you add a new price, and then it recomputes all the math and then plots the points for average, plus or minus 1, 2, and 3. And then it draws a line as if that's a continuous signal. So it approximates that, but it really is like a z-scored ladder that is redrawn. So there's z plus 1, z plus 2, and then z plus 3. Now I draw the Bollinger Band mean as that dashed red line because that's the centerpiece. That's the mean that everything reverts to. And then I draw the outer Z3 lines as thick red lines because that's going to contain like 99% of all the data of the look back period In this case, it violated just right in here, that one little piece on that given day, right? So any move beyond Z3 is abnormally abnormal. Now that sounds kind of funny to say it that way, but you got to realize that between Z1 and Z2 is like a normal abnormal. So it left the river, but it moved out to the floodplain. So that happens with some regularity. In the last 30 days, it happened 3 times. And when it reversed, it was significant each time. And then the further you go back, you would keep seeing that to be the case. Anytime price leaves the river, it becomes abnormal, and that's good because there's a real directionality to it now. And now here was a chance that it couldn't hold that any further and violated the edge of the river, became normal, came back to the mean like it should. That's the reversion to the mean that we talk about. And so in a long trending move, it's not surprising to see that strong bullish trend occur. That was sort of indicated by the willingness to get beyond Z3. And then you had this nice long run and came back, checked in at Bollinger Band mean. Is it going to fail? No, it's going to start the next leg up. And that was half as long as this one. And it came back to the Bollinger Band mean again. And it came back to the Bollinger Band mean again. Now this time, you notice that the excursion didn't last very long, didn't even get out to Z2 like it did the previous time. And now you can start saying, hey, the ability of the traders to move it away from the mean is a measure of their strength and conviction. And when this could not make a new Z2 excursion and started to fail, it's not surprising that it comes back to the mean and then fails to the downside. Then because longer term, that's part of this great upward move. Oh, that's an opportunity to buy it. And then all that buying pressure drove it back through the mean and then back to Z2 again. But now I'm noticing we're getting this oscillation. That's not good. Now we're starting to get more choppy and sideways. And now notice the slope of the river. Back here, it was kind of flat and sideways. And then when you get this series of higher lows and the excursion to the downside, this time could only get to Z1. This time it got to Z3 and then blasted up to positive Z2. Well, that's good. That's an argument for the Kata 2 entry. And now this thing blasted up to Z3. So you really like to see this 1, 2, 3, and go. And now it's leapfrogging to the Bollinger Band mean. But now when it couldn't make a new high, pain. Got to Z2, pain. So you can feel how in the last 30 days, that previous really strong trend in IWM is starting to decay. Now, it has fought its way back to the middle of the river where it is stable. This time it could only get to the Bollinger Band mean. It couldn't even get out of the river. But this time it didn't even fail out of the river. So now what's happening? You're getting a sideways quiet channel and everything is compressing inside here. Now, failure to fail is information, but failure to follow through is information. So now we actually have a different characteristic market type in here compared to this wonderful upward move that we enjoyed for 6 months. And now you can notice that the distance between the Z3 lines, which was wide during the trend, is now starting to compress and the slope of the river is getting sideways. So we've clearly entered a sideways quiet channel after a strong bullish move. And now we can say, what's the next move out of this train station? I see a low and higher lows. If it gets above 230, now it feels like it's going to do this. If it can get above 240, it will have exceeded the Z3, and that would be a very strong signal, much like this signal back here. When it was able to exceed the Z3, that was good. And in fact, if you go back even further, the last time this was in a sideways channel and the Z3 lines had pinched, the first move out of that Z3 was here, and then you get a higher low compared to this low, right? So you get the higher low, and then the beginning of this nice, long, powerful move. It doesn't predict it, but it describes it. So what we're facing here is the beginning of this next kind of that sideways channel. So we see coming out of COVID, this thing has gone through periods of big gains, consolidation, then the breakout from Z3, not so much. Yes, now it works. And so you get this next leg. So we can use the, just by watching the Bollinger Band means and envelopes and the slopes, we're getting a feel for market conditions based on volatility. So now when we look in at this, from Z minus 1 to Z plus 1 is the range of normal where 2/3 of the data can be found. Only 1/6 of the data is north and 1/6 of the data is south, approximately, under normal statistics. And so then I treat this range between Z2 and Z3 as a real warning that something is under tension and it's there could be something amazing happening, getting ready to happen, right? So that's the extreme of the extreme. If it breaks out beyond Z3, then it's truly extraordinary, and then all of the predictive and descriptive value of the last 30 days is sort of set aside because we had an extraordinary breakout. So I treat the river as normal. The move to the floodplain as a routine stretch of that rubber band, and it can snap back. Or it could be the beginning of a really nice move. So when you get really nice long-term trends, it is normal, like here, to see price living between a rising Z1 and a rising Z2 until it doesn't, and then until it becomes sideways. So I treat these as three regions inside this thick red line as sort of the professional distance that is described by the statistics of the last 30 days. And then breakouts beyond the red are really extraordinary. And then a stretch to the red that then reverses becomes a short-term swing opportunity, first to get back to the Bollinger Band mean, and then maybe some more. Well, this one got to the Bollinger Band mean, and then a second leg, maybe some more. A Z2 stretch back to the Bollinger Band mean, and maybe some more, and it did. So you can now start charting and feeling these moves using this framework of the Z3 lines, and you can see conditions of expanding volatility and contracting volatility, much like breathing. So this was kind of a, this COVID excursion here, that wasn't breathing, that was gasping. And that makes this little, the narrow normal range of the Z3 to Z3, when that breaks, that can happen. And then when it pinches and breaks out, that can happen. And when it pinches and breaks out, that can happen. That was a move from 140 to 230. That's a 60% move from here to here, whereas this was a move from 170 to 100, which was a 40% sell-off. So yeah, that hurts, but there's 70%. So the Bollinger Band mean framework then gives us the ability to appreciate the expansion and contraction of volatility, and marks off regions of price that we can then classify as normal, stretched, abnormal, and then genuinely revolutionary or catastrophic or nonlinear. A break of the Z3 now becomes an alert that something truly extraordinary could be happening. So that's the argument for the Z3 lines. Let me pause there. Okay, so now what I've done is cleaned off the Bollinger Band mean overlay, and now I want to talk about moving regression lines. So moving regression lines are simply linear regression lines that you update with each time period, and you plot the endpoint as the perfect price for that bar, that current bar, and then you connect all the previous endpoints, and that gives you the appearance of a curvilinear moving average. That's called the least squares moving average. Now, when I say that, what I mean is that when I look at the 10 period look back, so I'm going, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So when I look at those 10 periods, and if I were to, let's see if I can do a linear regression line from here to here. That should be plotting right there. Oh, that was a 30. Duh. For a minute, I thought I was losing my mind. So what I've done is I've plotted a moving linear regression 10, and I'm going to color that blue, and then that represents the best fit line of the look back period. So this trend line that I just drew is the actual linear regression for this whole, so that would be a 2-period linear regression, 3, 4, 5, 6, 7, 8, 9, 10. So now when I draw the 10, I get an arrow in here. So this arrow is pointing right where that linear regression line is drawn. And so that point represents the perfect price for this bar as described by the linear regression line. So the linear regression line is the straight line that minimizes the distance between all these points and prices that are off the chart. So math is performed to say, I need to draw a straight line that's the closest approximation of that data. So if I went back one more period, then the previous 10 period regression line from yesterday to minus 11 days ends up on that dot. And so if I kept marching that back one day, every dot that's on the blue line is where the 10 period regression line for that day ended up. And then the moving regression line simply connects all those dots, and it gives you the appearance of this moving line, right? So you can think of, in stats, we think about the difference between the closing price and the pure regression line price is called the error. How far off of the true value, the fair value of the regression line, is the current price? So the error of Friday was really the whole bar, because that's where the price ended up being correct, if we can say it that way. So one of the things that you get by simplifying price as a regression line is that it smooths out the behavior and gives you a disciplined, adaptive, mathematical, all-season description of price action. And the further out you look and say, yeah, that's actually a pretty good description of price, plus or minus the error factors, right? So if I added a simple moving average of 10, let's see, moving average. Simple. And did it on that, and then made that a 10. And I'm going to make this orange for a very specific reason. Because that's going to be the spine of the dragon when we get done with this thing. Now, what you can see is that that 10 period simple, or the 10 period simple, is very smooth. It has lots of errors and it is slow to respond, whereas the thick blue line is the moving regression line, and it is very adaptive to price. And it moves further when price is going down and rebounds faster and taller when price recovers. So you get a lagged smoothed factor on the 10 simple moving average compared to the 10 moving regression line. And in that difference, our little technique for the regression line crossing the dragon is in force. So the last section we talked about the 30 period Bollinger Band look back. Now what I'm going to do is I'm going to add a 10 period Bollinger Band. Let's see, Bollinger Band. And we're going to put it on price. And we're going to edit that rascal. And we're going to make it orange, dark orange. And the shading is going to be light orange. So it creates the appearance. And then instead of 20, we're going to make it 10 so that it aligns with the 10 period look back. And I don't want 2 standard deviations. I want half a standard deviation on either side of the dragon, because I want the width of the dragon from south to north to be 1 full standard deviation. Right? So half plus a half. And now what we get, I want you to notice that when the RL10 moves to one side of the dragon and then can't go any further and crosses, where it connects with the simple moving average right in the middle is those 2 moving averages now agree for one moment what that fair value is right there. Here, it was sort of the maximum difference between what the RL10 said was fair and what the 10 simple said in the middle of the dragon. So when it gets to an extreme and then rolls over and crosses the dragon, then we can say tentatively that the short-term 10 period fast trend has reversed. And now what do you get? Well, you get a swing move to the bottom. Now, this was instructive, and it came back, it rejected that, and then fell. And now it got to an extreme low. It reversed here, end of trend, enters, crosses, leaves, and now you get that positive upward move. So now when we look at this thing at a distance, we can see that the price oscillation on the 10 period look back goes through this series of oscillations. And now the relationship between the 10 regression and the 10 simple gives us some actionable moments. And actionable moments. And so the 10 period Bollinger Band mean plus or minus a half, which we call the dragon. Now I'm going to put back on the river So now we're going to look at the relationship between the dragon and the river. So make the dark blue, make the shaded area very light blue, so it doesn't obscure price too much. I want to plot a center line. That would be the, now because I picked blue, it wants to print that as blue. So just as a technique for TC2000, what I actually do is I like to see that as a red line. So I'm going to plot a simple, let's see, moving average, simple, and make that 30, and bright red, and dashed, or dotted, I should say, and thick, and make that 30. Yeah. Okay, and then the river, I got to go fix that. I need to make that 30 plus or minus 1. So now what I want you to notice is that we have the river is describing the 30 period look back as sort of like the health of the trend. And then during these periods of trending behavior, you notice that once this breaks out of the river and becomes trending behavior, that dragon swims from the south side to the north to the Bollinger Band mean, and then starts paralleling the edge of the river all the way up until things start to collapse and become sideways. And now the dragon is fully in the river and sideways. So the dragon visually allows us to start seeing what's going on with the trend and the strength of trend. Now, when I add the 20 period, I'm sorry, the 30 period Bollinger Band plus or minus 2, oops, wrong one. Bollinger Band. So edit. I want that to be dark blue. I want to shade it at 5%. And that's going to be 30 period. And that's going to be plus or minus 2. And I'm not going to plot a center line because I already have the center line. Oops, I made it 39 instead of 30. Sorry about that. And I want the shading to be blue, so it looks nice and pretty. And I'm going to make the edge of that dashed. So that it looks like semi-permeable. Now, when we're in these long, strong trends, you can see that this price, along with the dragon, is just riding along the edge of the river in the floodplain, very rich soil that's growing things until it can't hold anymore, and now it's oscillating between Z2 and Z2. And then I put that outer band of the thick red Z3s to really capture the price level that indicates a collapse of that entire narrative. All right. So that's what the Bollinger Bands are doing. Now what I want to show is, let me leave that on there for right now and add a couple of, so if the 10 is the fast moving regression line, the slow moving regression line is, let's see, is the 30. So that's 3 times faster, and that correlates with the look back period of the Bollinger Bands, the river. So moving linear regression, I'm going to put that on. I'm going to make that the color, the standard color of black. I'm going to make it thick. And now I'm actually going to take the Bollinger Bands off so you can see because I want to talk about these the relationship between regression lines right now. I'm going to leave the 30 simple on there because I want you to see that when the 30 regression crosses the 30 simple, something important just happened, because the 30 is now the strength of the health of the trend. When the 30 is underneath the middle of the river and then reverses and it crosses, when the 30 regression crosses the 30 simple, look at the trend that happens before it ever crosses again, which it just did up in here. So you get this entire trend to the upside as marked off by the 30-period regression line crossing the simple 30 moving average, the middle of the river. So on this one where that little pullback happened, that's just noise, says the 30, which came back but didn't cross and then resumed, and that made this a really powerful moment. And then that trend lasted all the way up into here till you can see now the 30 rolling over and crosses. That puts an endpoint on this trend right here. That's one leg. And if you go back and look at previous moments, here's where the 30 crossed the 30 on the downside. And then that lasted, if we want to call that red, until the slope of the 30 could no longer stay negative. Now I want you, this is going to lead you to understanding the owl pretty well. So notice what happens when the slope of the 30, which is under that dashed red line, but starts getting better. That's where the owl starts alerting you that, hey, that thing that used to be so horrible, it's not so horrible. You can actually think about getting long. That's an owl entry at the orange dot. And that's where we got long after COVID in IWM at a price of 110 with a stop below the swing low. That's aggressive. If you go conservatively below the RL10, you could have had a stop at either 102 or 95, depending on how aggressive you wanted to be. And then that never got jeopardized the whole way up. Now, here's where the 30 crossed the river right here. And the next time that it crossed the river was back here when it came back in here. So that's a positive leg. So if I show those positives as green, that would actually be better, wouldn't it? Yeah. So here's the next positive one, is it didn't stay underneath very long, but it crossed right back above pretty quickly and then gave you another nice little leg up to here. And then it crossed below and gave you a temporary warning. But then when it crossed back above here, bingo, you're right back into it. Don't you want to be long in the green boxes? Yes, you do. What was the entry into that? When the RL30, which had been below the 30 simple, crossed back above the 30 simple. So that's an important relationship. So the RL10 and the RL30 allow us to get even closer timing. Like here's where the RL10 crossed back above the RL30. We can already be thinking about getting long with the SSC and CATA 2 inside here. But the OWL entry, which is a little more slow and deliberate, says you can get long here, and bingo. So if the 10 and the 30 are the fast and the slow of that pair, 10 times 3 is 30, so 10 is the fast, times 3 is 30, gives you the slow. If we go up one intermediate time frame, we say, hey, what if the 30 were the fast what would be the slow? 30 times 3 is 90. So if I wanted to go up a factor of 3, but stay on the same chart, what I could do is now take and add a moving linear regression. Let's see, moving linear regression. And make that green because that's our standard color. And put that on the 90. A 90 period look back. That gives us an intermediate. Let me make that thick as well. So the 10 is the sharpest, and then the 30, and now the 90. So now when price gets across, or when the 30 crosses the 90, you get, it's almost like a 10-30 crossover, but on 3 time periods higher, like on a 3-day chart. Because I'm looking at a daily chart here. If I put that on a 3-day chart, this is where this would look like a 10-30 crossover. I say that, but I hope it works. And yes, it does right there. Because on the 3-day chart, the 10 period is the 1 day's 30. And then the 30 on the 3-day is the 90 on the 1 day. So that's where that crossover occurs, right inside there. And now this thick green line is really the 270 on the 1 day because that's going to be 3 times the 90. So now when I go back to the 1 day, you can see that the crossover occurred inside that yellow box, just where we want it. Now what I'm going to do is I'm going to add the slowest regression line. On price. And we're going to make that the 270. And we're going to color that purple and make it thick. That represents the. So I've actually got 3 pairs on here. The 10 and the 30 is the fast pair. The intermediate pair is the 30 and the 90. And then the slow pair is the 90 and the 270. So the relationship between the 90 and the 270 very slowly is the same fractal relationship as the 30 and the 90 and the 10 and the 30. It's just that they're 3, it's multiples of 3 on the time periods, right? And when the 90 crosses the 270, you get a real clear indication that the long-term fair value guys are interested in buying because they used to have fair value here and now they get a chance to buy it on sale after all the pain and suffering has been adjudicated and worked off by all the traders. That's a really strong signal right there, 90 crossing the 270. And you've been in that trade the whole way. You could even use the 270 as your stop. Ooh. So you get an entry in here at about 150 and your stop's at about 140. So 150 and then your first exit is maybe here. So you made 6R on a very relaxed entry. So now I want to, get rid of some of these other things because I want to show you while we're here the essence of the regression line fractal framework because we're here. So now what I want to do is I want to compare the difference between the fastest regression line, which is the 10, and the slowest regression line, which is the 270. So here was a moment at that orange dot where all of the regression lines pretty much agreed what fair value was going to be around 170. And then the traders the RL10 were able to stretch price that far away from the slow RL270. That represents the strength of the traders to move price away from fair value short term with their little momentums, right? And then when they couldn't move it any further, all of these other regression lines, the RL10 reverses, the 30 reverses, the 90 reverses, and the 270 reverses. And this is a reversion back to the equivalent of the mean, or a reversion back to fair value. So harsh sell-off and then a stepwise price improvement back to fair value. Now, one of the things that we notice is that the strength of the traders to move it in away from price or fair value in one direction is the strength here. Now, this will just scare the crap out of you. To the penny is how far they were able to move it, and before this thing started to waffle and get wobbly. To the penny. Now, you'll notice that the sell-offs happen much faster than the recoveries. And so just take a look at the times that it took. It took this long to shock it to the downside. And then the recovery trade back to fair value took that much time. And then when it got beyond fair value, when things were tentative, it took that much time to climb up the stairs once more. So people ask me, hey, Ken, why do you love the collapsing dragon so much? It's because you get all the movement in 1/10 of the time. And the bigger the sell-off, the greater the probability that that was an error or an emotional move and that the world's not going to end. And so you get a rapid recovery back to fair value, which is 1/3 of the time or 1/4 of the time that it takes to just continue to grind. So, yeah, this isn't recovering as fast as the sell-off was harsh, but that's still 4 times faster than this long, painful grind. So you love volatility. You want to see massive sell-offs in order to create these kinds of moves. So on this move back up, when you get the RL10 crosses the 30, that's a signal. When the 30 crosses the 90, that's a signal. When the RL10 was moving back up towards the 270, when it got halfway, it crossed the 90. That's like the intermediate confirmation that the move is happening. So you get half a move and half a move. Is there volatility along the way? Yeah, that's why you have shorter term swing trades and you pay attention to the Bollinger Band means and honor your stops, because you don't know that this wasn't going to come all the way back down. And you don't know that this wasn't going to come all the way back down, so you honor your stops. And now when you put this on a weekly chart and you go back and add the dragon, you're going to realize that the southern skin of the dragon on the weekly is amazing. Going to make that orange. And the outer skin thick orange. We're going to make it just 10% for effect. We want the line width to be thick. And we want it to be a 10 period. And we want it to be 0.5. Tuning. Now let me get rid of some of these other things. Remove. So now if I get when I get the RL10 has moved to an extreme, as we saw from the previous chart with all that crap on it, but then the RL10 crosses the dragon, there's your kata 2, where your supported spring crossing. And now you get these nice moves. Here is the southern skin of the dragon acts as your stop. So you get that first leg, and then when it leaves the dragon again, you get an entry. And this probably stopped you out. That's all right. Because the RL10 didn't even get into the dragon, and that resumption is a kata 2. And now you get this entire move all the way up into here. Just managing weekly charts gives you a very clear indication of where you need to be. If you put half your long-term portfolio on the weekly as a guide and then half on the daily to refine that, you could go core and turbo with weekly and daily with a minimum of managerial complexity. The final thing I'm going to add to this now is the parabolic stop and reverse, because that gives us a little bit more insight. That's an extra refinement. As I started managing my stops, I tuned the parabolic stop and reverse so that it looked like where I was moving my stops when I was getting in here close. Now, what I'm going to do is I'm going to put the price history. Oh, I got to put it on the RL10. Now, look how smooth those PSAR dots are in terms of defining where the primary trend is. So even though this was an exit, it told you, yeah, you could, as soon as it went out of the dragon, price went out of the dragon, you could buy it and hold and hold and holding all the way up into here. It's starting to get a little iffy. Yeah, it should. It's just made a move from 95, almost interrupted, to 230. That's a 350% move. Yeah, it's starting to. That's what happens when you print $10 trillion and dump it into the market. Give it to the banks and those guys. Anyway. So now when you put all that stuff together, get all this junk out of here. You have a complex looking dashboard, but the different components are all related to each other in various ways, right? That I just have been describing. The final little refinement I put on is when the RL10 reverses, especially beyond Z2, I put a little 3-period simple moving average on that to tell me what that short-term refined swing looks like. So now when the RL10 crosses here, I can get long here and stay in there as long as the RL10 is ahead of its 3-period moving average until it no longer is. And then this one tells you, the rollover is here. Beware, you could be getting one of those. Oh, nice. Oh, here, alert. You can already start getting long. Alert, it's over. So now the length and the amplitude, the frequency and amplitude are starting to tighten up. So this is becoming more of a choppier sideways. But now what you have is an explanation of all of the different pieces on the dashboard. And you should or could tune those to the way that suits your decision making. So that's what I want to say about all of those indicators. Okay. And I hung a chart. I will hang another chart. I'll hang it again in Patreon that lists all of those indicators, their names, their purpose, their parameters as a one table summary. So as you're thinking about how to put that in there, the final thing that I would say is that based on the discussion I had this morning, I talked about the MACD histogram as a simplification of this so you could get the seasonality. And all I've done there is taken the season from the MACD and color-coded the price so that without using screen real estate to just figure out what the 4 seasons of MACD are, I can see that in the color code of the RL10. So like here is fall, and now it turned to summer. That's good. Turned to fall. Oh, winter. That's bad. But winter has turned to spring. This is becoming tentatively good. If it breaks out of here at 228, the spring could become summer, and then all is well. And then if it gets above 234 and beyond Z2, this thing is free and clear, and off it goes. And then it will have solved this sideways choppy action and resolved it to the upside. If it can get above 232 and then 240, then it's free and clear, much like it was back here. All right, that's everything I want to say about that. Thanks for playing along, and I'll get that stuff posted and processed. Take good care.